Hey, welcome to the Millennial Money Canada podcast. I'm your host, Guillaume, and thank you for taking the time to listen to this podcast. If you're a new listener, welcome. Our goal is to help you elevate your knowledge about finance so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. Today, Sam and I were joined by Amanda Doucette, a tax lawyer and go-to expert in estate and succession planning for high net worth families, cross-border situations, and legacy trust. She has a master's in tax law and she's completed her CPA Canada's in-depth tax course. She has deep technical expertise in everything that is related to tax and law. She's also a recognized leader in her field, a strong advocate for tax in Canada. She's named one of Canada's top 50 lawyers. She's also the founder of the Tax Chick blog and podcast, where she simplifies complex tax topics with curiosity, clarity, and a sense of humor. It was a really interesting conversation where we touch a number of topics from her past experiences, stories, and tips of what she's noticed with certain clients, mistakes that are common around succession planning and tax and estate planning, but also some technicalities around corporate structure and the implementation or the use of holding companies and family trust. So I hope you enjoy. And with that being said, let's go to the episode. Amanda, welcome to the Millennial Money Canada podcast.
Thank you so much for having me. I'm excited.
Can you share with the listeners like why and how you ended up choosing or pursuing a career as a tax lawyer, and also give a sense of what you do to someone who may not be familiar with the role of a tax lawyer?
Sure. I mean, I did not want to be a tax lawyer until I became a tax lawyer. So I went to law school to do family law, litigation, maybe a bit of human rights. It was kind of my idea. And I took no tax courses, no business courses. Well, that's a lie. I took one tax course in law school, like the minimum that was required. And that was kind of it. I was taking all the advocacy courses. I clerked for the Court of Appeal here in the province because I wanted to be a litigator. And I started kind of down that road when I started practicing, but I really wasn't happy. Like I found the first couple of months of practice, I was not feeling fulfilled, not feeling excited. And I went like, what's wrong? Is it me? Should I not be a lawyer? Like this crisis of conscience at 25, right? And then one day, one of our partners came down the hall and asked if I would help with a tax litigation trial that was happening in October of that year. And I can see him standing at my door. Like that was almost 20 years ago, but I can see him standing there and asking me. And I said to him, I'm really bad at math. Is that okay? And he's like, oh yeah, you don't have to be good at math. It's fine. And I said, okay, but like I warned you, like this is it's not my strong suit. And so we did this trial and I fell in love with tax law. And the reason why I loved it so much is I think I didn't know what it was. I think we have this preconceived notion of what it is to be a tax lawyer. And I assumed it was someone with spreadsheets and a calculator and like doing math all the time. And I didn't realize that being a tax lawyer also has an advocacy component. And that's what I fell in love with. And our client at the time, she was a teacher and she had a bunch of rental properties. And she had received a little bit of information from an accountant. And she was one of those people that kind of like got some information and like ran with it in a very bad way. And so she started reporting all this rental income, but she wasn't reporting it in the right place. And then she was reporting expenses in the wrong place. And CRA came in and assessed her and all of her companies, and they hit her with gross negligence penalties. And she owed like $500,000. And she was, soon to be retired. This was a big deal. And so we were able to help her. We won. We got her out of it. And then as part of it, I saw that, as tax litigators, we also have to provide support going forward for the client. So we spent some time talking with her and being like, here's how we have to structure it going forward so we don't have this problem again, and kind of help to educate her. And that was so cool to me because I thought, wow, like I could advocate in a different way than I thought. And that's what got me started in tax law.
That's awesome. What's the clientele that you focus on today, more specifically?
So I think my practice has changed a lot over the years. And so I started as mostly just a tax litigator, and then I moved into doing a bit of tax litigation as well as like corporate tax planning. So I would reorganize companies and that. And in the last, 5 to 6 years, I feel like my practice has shifted again. And now where I'm finding the need is in the really complex estate planning and estate administration. And when I say complex, I mean, clients with multiple companies, usually with assets assets or people
Yeah.
overseas, or at least in different countries. Long-term legacy trust planning, like that kind of stuff, is where things have moved to in the last few years. It's very fascinating work, both to plan before someone passes and then also to support the family afterwards, because you're often juggling multiple tax regimes of different countries and trying to work with advisors in other countries around the world to make sure that you're not doubling up on any of the work. And that's really where I'm finding my expertise is being used today. Yes, I'm also still a tax litigator, and that's a large piece of my practice. But a lot of the corporate reorganization work has now been shifted to more, senior associates at my firm. Well, I can then go in and do the big picture plan and try to support the
Is
families.
it the complexity of things that like provides some excitement for you now? Because I imagine you've been doing this for a long time. You've probably seen a lot of things, but like you mentioned, like working with clients with overseas assets and things like that. I imagine that there's just something new still coming to the table for you. Whereas like maybe if you're just
Yeah.
working with Canadian clients, it's maybe the same old over and over. Is it the complexity that gets you excited about this stuff still?
Well, I think as a tax lawyer, it's never like you just
Mm.
never know everything. And that's one of the things that is a bit of a struggle to sometimes get people into tax law or into even like a tax stream in the accounting world. Because every day I get push downs with, how many different changes that have happened
Yeah.
in our country alone. And if we think about how our tax regime has been completely upended in this country in the last,
Mhm.
8 years, well, pretty much since like 2016, 2017, it's been a disaster. So you're constantly relearning. And even when there were plans that used to be cool and kosher and we could do them, now we can't anymore. And so you're constantly relearning that. But for me, I get bored really easily and I've always been like that. And I love to learn. And I'm the kind of person that if something is like ugly and messy and like challenging, I'm in. I'm like, let's go. I don't want to do 10
Mm.
of the same plans. I want to go to the plan where we don't have a plan and I need to come up with a solution. And so I think that's what's led me to do a lot more of this other work. Also, our clients need it, right? I think our clients are increasingly global. And so as a result, the client base of our firm got more complicated and someone needed to learn this stuff. So even like in the new year, I'm taking a certificate course on international estate administration because I feel like there's an extra level of education I can take to even better certify myself to do the work I'm doing. I just can't
Mhm.
stop learning. It's the kind of just the way I
I feel
am.
like that's an excellent example of even throughout the years because it sounds like you're established, you've been doing this for a while, but like continuing to grow with your clientele, right? Because I think it's really easy to like get clients when they're at a
Uh-huh.
certain place in their life and then not really evolve how
Uh-huh.
you service them when their needs evolve. And I imagine
Uh-huh.
as a partner in your firm too, we want to keep those clients long term as, clients of my firm, we want to keep them long term. And so it's like, how do we evolve
Uh-huh.
and keep learning and keep growing with our clients? I feel like that's a really cool um story and path that you've been able to
Uh-huh.
accomplish there.
Yeah, I agree. I think that, we really love our clients. And one of the things I love about what I do is we have really good clients and we attract really good clients and I really want to help them. And so I need to be the best that I can, which makes my job exciting, which, helps me to want to get up in the morning and go to work, but then also provides a solution for them. So it's kind of a win-win. And you're right. I think, as our clients even go from like, startups to now their business is really successful. Well, they have still the same issues, just at a different level. And so you got to meet that level. Because
Mhm.
that's the client trusts you and you have all this soft information, from the years of servicing them that's so valuable. So you also need your technical skills to be where they need to be to continue that good service at a technical level too.
Mhm. Yeah. Yeah, one of my goals is I never want to be outgrown by a client.
Yes.
And that's why I'm always seeking, and we talked about it. I know you have your TEP, Trust and Estate Practitioner, and
Yes.
but in our industry, like I'm always looking for certifications to make sure that I'm either, already
Mhm.
ahead of our clientele, depending on where they're heading. But yeah, I never want to be outgrown from our clients. I have a question for you around, in terms of like what kind of sets you apart in terms of your firm. So in our world, services are all over the place.
Yeah.
Is it what I mean by this is like different advisors will have different approaches, different focuses. They'll literally have like, very different ways of doing things of either managing money or financial planning or pushing insurance, you name it.
Mhm.
In the tax lawyer field, is it more seamless in terms of like the services between different firms and the approaches, or like what or is there's as many differences as like in our field and around financial planning?
I think that's a really good question. And it's kind of hard to answer because I mean, I haven't worked at all the different
Yeah, I
firms
guess
to
you know
kind of
you're
know.
yeah.
But I think, if you've met one tax lawyer, you've met one tax lawyer. Like, I think that's the answer in that when I have students say to me, I think I want to be a tax lawyer, what are my options? And I'm like, well, the world's your oyster because if you're at a larger firm, you're probably going to end up being very specialized and you're going to be so amazingly good at this one little piece of tax law. But if you're at a smaller boutique firm, you're now going to have to start layering tax law over the corporate law or the litigation law or whatever it is that you're doing. And so I think that from a practice perspective, even how the scope of how much is different depending where you are. I think that I've always practiced tax a little bit differently, and I'm not the only person that does this. I've got legions of fun, friends across the country who practice exactly the same way. I'm not unique in that way, but I think I'm different than a lot of other tax lawyers are. And I found when I started to practice tax, like you kind of get in this little black hole of the way that things have always been done. And it worked and it's fine and there's nothing wrong with it. But I didn't feel comfortable in that space. Like it felt like I felt like I was closing off a part of myself being in that space. And so I am not the tax lawyer that you call if your goal is never, ever, ever to pay any tax and you don't care about anything else. If you want to do the most aggressive, risky plan, if you just want to talk numbers, if all you care about is tax, you're probably going to be pretty miserable in a call with me because that's not how I operate. I operate in a different world where I want clients to understand here's the tax consequences, here's the non-tax consequences. You tell me what's most important, and I'm going to give you your risk scale. And so most of my clients tend to be in the conservative to sort of moderately risky. I don't have aggressive tax planning clients because that's not my personality. And so I developed this kind of educational approach to dealing with my clients because I want my clients to actually understand what we're putting in place. I want them to be able to go to the coffee shop, talk to their friend and say, hey, I have 3 boxes. This is the stuff in my boxes. We put in this trust. Here's why. I don't need them to tell me the sections of the Income Tax Act. Like, I don't care. But they should know what they own and why they own it that way. If they have an insurance policy, why? What's it there for? Take control over it. And I've said to my clients, like, this is your money. You have spent all this time building up this business and you're so successful. Why are you throwing it in my hands and being like, here, do whatever you want with it? Like, I can, but don't you want to at least know or like be part of the process? So use me as the guide to tell you, here's your options. Here's what it looks like. Batter me with questions, whatever you need. Let me be the translator to the other advisors that you have. And then you're going to walk away knowing exactly what your plan is. And you're going to know when the red flags hit because I'm going to tell you what those red flags are so that you phone us before you do something that can't be undone. So I think that's maybe a different twist because traditionally it was, we are the tax lawyer. We don't need to explain it to you because you've hired us because we have expertise. So just trust us. We're going to do this and you're going to be happy. And I think that was the way that it used to be. I don't feel comfortable that way. That's just not how I roll. But there's lots of clients that don't like how I roll, right? Some people just want to be told.
Yeah, that's you mentioned a few good points here. We had an accountant on the podcast a few months ago, and he talked about tax risk tolerance. And you in the investment world, we talk about risk tolerance all the time, right? Like, depending on the different goals you have, your time horizon, your liquidity constraint, right? All these things. But in your tax risk tolerance, I thought was fascinating, right? How willing are you to walk that line versus where, yes, you might get not away, but you might be able to pull it off, but then you might get it, again, you might have CRA like knocking at your door at some point, so you need to be able to defend what you've implemented, right? So that's fascinating. Yeah. Talking about education, can you talk about, because not every tax lawyer has a podcast and you have the tax chick, can you talk about your motivation around, wanted to, share knowledge about, tax law in Canada and, behind the podcast itself?
Well, it's funny. I just released an episode of my podcast talking about this because I get so many people asking me, like, why did you do this? And I feel like I've told people, but I clearly haven't told it clear enough. So happy to chat about that. I mean, it was 2020, right? We were all in lockdown. And the tax rules were changing every 5 minutes. And, I was dealing with it with my own business. I was a partner in my own business. I had employees, I had rent to pay, I had things happening. But then I also had all these business owner clients, and I had friends that had startups and businesses that were phoning me all the time to be like, what do we do? And I started thinking to myself, like, okay, these people know they can call me because they're my friends. And I'm not going to charge them because this is an emergency situation and I just want to provide support. But there's so many people that don't know that they can call me because they don't know me or they don't know where to go. And they can't afford to get proper advice right now because like nobody has any money because the whole system is collapsing. So is there a way I can put information out into the universe that's like an objective, safe space? And so I started with a blog. So I had the Tax Chick blog starting in May 2020. And I started doing weekly blog posts and started posting on LinkedIn about them. And then all of a sudden, I started getting like DMs and messages saying, hey, we'd much prefer to listen than to read. Can you do a podcast? And I had podcast equipment sitting in my basement because the year before I'd been floating this idea out of a podcast about Saskatoon with some friends, and it just never went anywhere. I'd even hired like a marketing person. We had a name, like we'd kind of like gone down the path, but it just, like when in your heart, it doesn't feel right, like your soul's not in it. And so it sat there and it collected dust. And I was like, well, I got this equipment. Like, I don't really know what to do. And my husband at the time, he's still my husband, but my husband was starting to, sorry, that sounded bad. My husband was starting to work on making his own music. He was starting to develop that passion and that creative passion. And so I was like, hey, do you want to make my intro and outro music? And he was, well, yeah, I'll make music for you. So then it became this project for the two of us. And for me, it wasn't the recording or the coming up with the episodes that was stressful. It was like the logistics of what button do I press to get this thing out into the universe. And I didn't know what to do. And so I was saying before we started recording, I was saying I called this guy up that lives in Saskatoon, Chris Enns, Lemon Productions. He's a great guy, and he does a lot of editing for podcasts in the US, and he offers these like hourly consulting. And I called him and I said, I'm scared to push the button. Like, I don't know if I'm doing the wrong thing. And he walked me through everything and kind of got it going, helped me figure it out. And then I just started putting it out into the universe. And I found that I really love talking about this stuff. I was having all these great chats with friends of mine, and I really wanted to make it sound like as if you were eavesdropping on our conversation. To get people just comfortable being in a space where they want to talk about tax. And I'm sure you guys find this in your industry, like finance, investments, tax. Everyone gets freaked out and they don't want to talk about it. And they think that they're not smart enough or they think they're not good enough. And yes, anybody can do this. Like if I can do this, anybody can do this. And so I think this was a way of actually trying to create this movement, which I don't know if it worked, but this movement in Canada of people to like the average person to be like, hey, I actually know a little tax tidbit I can talk to my friend about. I know what to ask my accountant next time I go in. That was the initial goal of the podcast.
So you hit 40,000 downloads recently, if because I listened to that podcast. Is that right? 40,000 downloads now? That's amazing.
Yeah. Which is, well, thank you. That's very kind of you. It feels like it's not that much, right? Like when you compare it to the big ones, but I'm like, just like you guys, I do my own editing. I do my own promotion. I also have a full-time job and like I run a business. And so it's like, if I can get 40,000 people to listen to tax, like that's not bad.
That's what I mean, right? Like it's not like, it's not like you're talking about, adventure, discovery as your main theme anyways. I'm sure that's sprinkled into the podcast, but like talking about Canadian tax, talk about like, in no offense, but talk about a boring concept, and it may be a scary concept for so many people, and yet you found a way to make it fun and exciting. And that's really cool. And also I'm like, really excited about it because you're from Saskatchewan. I'm from Saskatchewan. I lived in Regina for 13 years, right? And putting Saskatchewan on the map's always a good thing too. So that's really exciting.
Yeah, I agree. And I think sometimes like you have to lean into what makes you weird, right? And I feel like there's a lot of things about me that are kind of weird. Like I'm from Saskatchewan, and I feel like no one's ever heard of Saskatchewan. But now, Chapel Roan's put us in her song, so like we're here now. We've made it. But it's like I'm from there. I'm a woman. I don't wear black. My hair's purple. Like I do stuff that maybe doesn't look like a traditional tax lawyer. And for a long time, I tried to hide that, and I kind of just tried to be what I thought it needed to look like. And now I'm like, that's part of who I am as a person. I believe in using humor. I believe in addressing asking things directly. And I also believe in being very raw with my clients when there's something I don't know that I need to level up on. I say, hey, like, I don't know. I'm actually really curious about this. I don't know the answer either. Let's try to figure this out. And I think there's a relatability there, and that's so important. So our clients don't feel like they can't come to us with questions.
I feel like the world would be a better place if more people kind of just were like their authentic selves, especially when they're in the public spaces, right? And if you try to conform and just be like everyone else on the public spaces, then it's like, well, what makes you unique? And you almost have to lean into that. And it's a hard thing to do, right? I don't claim to have figured out exactly how to do it, but it is harder than it sounds. So props to you for being able to figure that out and do that. Yeah, it's awesome.
Yeah. All right. So the topic of today, one of the things that we brought you on today, at least I wanted to pick your brain, is the majority of our clientele, are business owners, and they tend to be in this stage where we may sometimes be their first financial planner. So what I mean by this is usually they'll start accumulating retained earnings in their corporations, and then they'll start engaging with us because they'll have like a number of questions. And one question I have with you is, what do you see is one of the most common mistakes from business owners who may be in the accumulation stage that they may pursue like a certain strategy? For example, they might be, setting up a holding company, they might be setting up a family trust, or they may not, right? But what are some of the common mistakes that you're seeing people making in that kind of stage of their wealth accumulation?
I think there's two mistakes that come to my mind. So I think the first one is failing to get proper advice, and we'll go into that in a minute. But kind of the do-it-yourselfers. That's mistake number one, right? I think mistake number two is not taking the step to understand their numbers. So if you don't know your numbers, you don't even know you need help. And not knowing your numbers has such a ripple effect because you're going to have lumpy cash flow. If you go to get a loan, you don't even know what to tell the bank because you don't know what your numbers are. And you don't actually know if you're profitable. You don't know if if your expenses have gone out of whack. You don't know if it's time to hire someone new. You don't know anything. So not knowing your numbers is a huge thing. And so I think that ties into sort of having a team and having proper advice, because that allows you to be educated on the basics. So you know what lines you're supposed to be looking at. You can ask someone else to give you those trigger points. I think a lot of clients, when they're in that sort of beautiful growth phase where they're not a startup anymore, now they're actually like successful. And then they're successful, but they don't necessarily know what that means. Success might be that, lots of money's coming in the till every day, or they've got a lot of followers on Instagram or whatever. But they can't necessarily translate that into what the next step is. And we spend so much time in our industry talking about how you go from like a sole practitioner or, an independent business owner to a corporation. And that's its own leap that people often make too quickly without realizing what the plan is. But then I don't think we talk a lot about, okay, now you have a corporation. Now what, right? Like, what's the next step? And that's when we see people setting up holding companies and sometimes doing that too early, creating family trusts. So I think those are the two mistakes I see, is not really knowing what their numbers are. And then two, sort of hearing something on the news or like talking to a friend and they're like, yeah, I have a holding company. And they go, okay, I'm going to set one up too. And then they just create another company and nothing happens because they haven't got the advice.
So what would you say are the most important numbers for a business owner to know?
Well, I mean, I think your retained earnings number is pretty important, right? I think also it's pretty good to know what your debt is. Like, what are your long-term debt obligations? Because you want to be considering that on a go-forward basis in terms of your profitability. And then I think really taking some time to break down your expenses. A lot of people have like the one-liner, but they don't break it down in their GL as to like, where is that coming from? Because we can leak a lot of money without realizing we're leaking money. And so really stopping to go, where is everything going? Like, it's coming in and then it's leaving. Is there opportunities to renegotiate contracts? Is there opportunities to consolidate things? What can be done? Because sometimes that little bit of savings across the board actually starts to make a big difference. Those are some of the big things I would think initially.
I did not expect that answer. And let me, no. What I mean by this is, of course, a lot of people that we meet sometimes, like, we are in a way forcing them to get organized in some
Yes.
instances, right? There's sometimes I ask clients like, hey, how much is left? And high income earners, like, how much is left?
Yeah.
And they're like, yeah, I have no idea. I can't even give you a
Correct.
ballpark, right?
Yeah.
But on the personal side, but I always assume that maybe on the business side, everything would be like T's would be crossed, I's would be dotted, and they would know. But clearly not. You can see the
Mm-mm.
same parallel of having a really good grasp of the business numbers. But like that makes sense because
Mhm.
a lot of people, not everyone is really spreadsheet and budget oriented. So of course, the mistakes made on the personal side, you see the same thing on the business side. That's so interesting that you brought that up.
Well, and
I've been
even some of those weird little tax problems that pop up, right? So I find the business owners in that stage, that's when they get the CRA audit and they've got all these shareholder loan benefits, or they're paying a bunch of, personal stuff with the corporate card and they've got this complicated spreadsheet that's back. And I'm going, whoa, like what's your GST situation? What do your invoices look like? We're almost going back to basics because now they've got a more complicated structure, but the foundation's crumbly. And we got to fix the foundation before we can take the next step and make it more
So on that
complicated.
note, like for the individual who's moving from a sole proprietorship to a corporation, or even the individual who's newly incorporated,
Mhm.
what is like the most important things for them to take stock of, how to get organized, those types of things, so that 3 years down the line, when maybe the reason for incorporating was because they saw like 200,000 of revenue in the year, and so they bumped it up, and now 3 years down the line they're
Sure.
like 600,000-700,000 of revenue, and you're like, oh my goodness, this just kind of escalated. How do we avoid getting into that situation 3 years down the line where everything feels overwhelming and they're leaking money, like you were saying, and all of that stuff? Like, what are the things they need to do today?
Well, I think it goes back to getting proper
Hmm.
advice at the front end. And so, like, who's your team? I think that the team does not need to be a group of people you have on retainer constantly because there's a cost associated with that. But I think if you're prepared to take the step to incorporate, you better be prepared to pay someone. That to me is the step that you can no longer DIY this. Like, you need to hire someone and have a 1 hour consultation with an accountant, with a lawyer. Make sure you have a bookkeeper either that's taught you something, or like I do my own bookkeeping because I have always tried to sort of promote this to clients. And so I took my friend Jamie Monty's Chill Books course and I do my own bookkeeping using QuickBooks every month. I mean, we have people at our office. I have financial people at our office that do the bookkeeping for my firm, but I review it all, right? Like I'm still involved in the finances because I'm not going to let someone else handle that. But I think, you need that team. And if you're thinking I want to incorporate, but you don't want to spend money for an hour of someone's time, you are not ready to incorporate. I think that is step number 1. So once you get that proper advice, those people are going to tell you things like, you need to change your mindset in terms of how you remove money from your business. Because once you have a corporation, of course, it's not your money, it's your corporation's money. And if you're taking some of it, you have to allocate it somewhere, not like when you're a sole proprietor, you just take stuff. So getting the system set up so we have separate bank accounts, we have different credit cards, creating that foundation so that you don't have to think about it all the time. I think that's really important. And I think also someone needs to have a conversation about what your next trigger is. So, fine, you set up your foundation. We know what we're doing. We got separate everything. We got a plan in place. Wonderful. But then I have clients go, well, then what? Like, what am I supposed to be watching for? And they get a little panicky about that. So I think it's like, okay, well, you're maybe watching your retained earnings line, or maybe you're watching your net profits. And you're saying, okay, if my net profits get above X, and I'm not intending to use some of that to put back into the business to grow the business, well, now I've got a little bit of a problem because if I want to sell this business, I'm probably going to be offside whatever the rules are at the time, in order to access the capital gains exemption. And so that's a problem. Therefore, I probably want to get the extra stuff out. So if you have too much good stuff, too much cash, too much investments, that's usually a trigger to be like, okay, am I reinvesting it? Am I creating a holding company? But I think, again, you want to get your team in place. You want to find out what that's going to cost, what that's going to look like for ongoing costs, not just the cost to do it, but what's your ongoing costs. And then you want to make sure you have a handle on logistically, how is the money going to move? Like I'm all about where is the money going? Because I think we talk big picture and then I'll have a client phone me and say, okay, but wait a minute, what money am I moving where? So we forget sometimes that macro, piece or the micro piece of like, okay, now we got to get cash from this bank account to this bank account. And now we need new CRA business accounts. We need a new GST account. We have another set of GST filings. We got to get cash over so we can do, another set of installment payments. it's its own beast. So I think there's another time frame where you need to hire those advisors again to kind of figure out if this is the right time for you.
It sounds like to me that you're advocating for people to take very extreme ownership over their financial situation, which is
Yeah.
Yeah.
a kind of common sense when you think about it. But so many people
Yeah.
are very passive in that sense. You know, they're maybe just single-minded, focused on their business, and they're like, I'll worry about everything else or my tax. Like you said, like, you know, people say,
Mhm.
trust me with all your money, right? Or trust you with all their money. And then they don't want to take
Mhm.
an active role in that. But you're very
Mhm.
much pro take an active and ownership role over everything that you do in your finances and tax situation.
It might be a lofty goal, but I feel like it's what I've been preaching for quite some time. And then every now and then I'll have someone like call me up, either a listener or sometimes even a client themselves. And they'll be like, thank you so much for making me feel like I could ask that question. And I'm like, yes, that's what I'm trying to do, right? Like you just feel so good about yourself when you actually understand. And you don't need to be the one that comes up with the solutions, but you need to have the courage to reach out because I mean, face it, all of our advisors are busy. I'm busy, right? Like I don't have time to like look at my clients' files once a day and think, should we do some planning here? Like I don't have time for that. So sometimes it's like time goes by. And if the client doesn't do the nudge, I won't do it because I don't know that the client has increased profits. I don't know that's happening. So sometimes it's like you have to give the nudge to your advisor to say, hey, I want to talk about this now. And maybe even though you're having the conversation, you may not pull the trigger in that moment. And that's okay. But the conversation should leave you understanding what is that time frame for when you are going to pull the trigger, right? Like sometimes you just need that reminder of you're looking for X and when X happens, we're ready to go.
Mhm. In your experience, what's the amount of retainer, assuming that someone has a
Mhm.
business and has the intention to sell it and then claim the lifetime capital gains exemption, and they want to make sure that they're meeting all the different tests to qualify for it. Like, what's the amount of retained earnings that you would suggest that would make sense to move to a holding company, and then also it would justify the accounting fees and legal fees that of maintaining a holding company and whatnot? Like, is there's like a ballpark that
Mm.
you're trying to see, or is it case by case?
Well, I think it's not just what the amount is right now, but I think
Mm.
you also want
Oh,
to project, right?
right, a
So I
future
think
yeah.
just as you guys would know, right? So
Mm.
I think, if we think about the test, so if we're thinking about the lifetime capital gains exemption, and
Uh-huh.
I'm oversimplifying the test, but the idea is at least 90% of the assets in your business must be used principally, which means over 50% in active business.
Uh-huh.
So if I have a company worth $100 and I have, $80 in that company that's equipment, inventory, the good stuff. And then I have $20 that's cash, I'm offside
Mhm.
at that moment, right? So at that moment, it would look like that company is the type of company that should be considering a holding company.
Right.
But if that was a weird year and you're going to use 10 of that $20 that the company has to reinvest in the business or use it for some other purpose or pay it out because now finally you're making some money. So now you can actually pay that out to the owner of the business. Well, if you're not projecting those same types of things going forward, maybe you're not there yet. Maybe we look at dealing with it by paying yourself a little more and you take the tax hit or whatever you want to do for that year.
Uh-huh.
But then we start paying attention because if every single year you're growing more than you can use, that's when we start having a bit of a pattern, right? That we
Uh-huh.
want to deal with. So I think a lot of people pull the trigger if they have one good year and then the next year they don't have a good year. And now they're paying fees and they've got this more complicated structure and they're going, "Why did we do this?"
Mhm.
Well, because we didn't project out.
Mhm. Yeah. No, that makes sense. What is I know you mentioned that one of your big focus or main focus is on, estate planning, succession planning. So what is one of the most common structure that a successful business owner who's accumulating retained earnings would look for, implement, um, whenever that makes sense, assuming their current retained earnings, but also expected accumulation of wealth. That they should consider at least, again, and that's also case by case, right? But let's just assume here, a traditional, couple, they may have kids as well, and they may both maybe involved with the business, or maybe it's just one partner and then the other one has a career. Yeah, what are the common, like, structures that you're seeing?
Well, I think the common structures have changed a bit because of
Mm,
the tax changes. So,
mhm,
one of them that's still kind of sticking around, but again, it depends on your circumstances whether it works for you,
mhm,
is if you have one box and that's your corporation, and let's say we have, parents, mom and dad are the owners of that business. And right now, all the growth is accruing to mom and dad.
mhm,
Then we have to look at, from an estate planning perspective, if mom and dad were to die tomorrow, we have a deemed disposition immediately prior to their death of all of their capital assets, and then it gets reacquired at fair market value. I call it the biggest yard sale of your life. We can defer that problem on the first spouse to die, but when the last spouse dies, there's no deferrals unless we fit into other categories, right? So
mhm,
starting point, mom, dad, both die. We've got these shares in this company. And so you'd look at what they paid for the shares originally, like what's the cost base of those shares. Then you look at what the fair market value is of the shares now. Once we've done that, we figure out what their capital gain is.
mhm.
And we know that if they were both to die, someone's got to find the money when they die to pay that tax bill. So what we will sometimes suggest is even when we have clients that say, I'm never selling this business, I will say, well, do you plan to die? And then usually they laugh. And I'm like, no, like I'm serious. Like you're going to die, right? And they're like, yeah. I'm like, well, then you're going to be deemed to sell it at some point. And so what we'll sometimes see is we will see people engage in what we call an estate freeze, which I know you two are probably very familiar with, but this concept where you take common shares, which are shares that go up and down with the value of the business, you throw them in the hypothetical tax freezer, you pull them out from their little ice cube tray, and now you've got these frozen shares that are called preferred shares that have a fixed value that is equal to the value of the common shares when you shove them in the freezer.
Mhm.
And now you need to find a place for the new growth. So everything going forward in that business, you need to find a place for it to go. And sometimes we see the use of family trusts for that. So we will use a family trust. Mom and dad will be the trustees of the trust. Mom and dad will be beneficiaries of the trust. Kids may or may not be beneficiaries. Other corporations controlled by mom and dad may be beneficiaries.
Mhm.
This allows growth to accrue in a different direction, which means if mom and dad were to die, the shares the trust owns do not fall into the yard sale because they're not owned by mom and dad anymore. And then you work over the next few years to redeem or buy back the preferred shares, and then mom and dad get paid dividends, a deemed dividend arising out of those preferred shares, because you want them down to like zero in preferred shares, and
Mhm.
then you want the growth going to the family trust. So, I mean, family trusts are great. They're not as great as they used to be 6,
Mhm.
7 years ago. But I mean, a family trust, you could take a dividend paid up to the family trust. You could allocate that dividend out to mom and dad, out to kids within certain, boundaries and requirements, depending if they're working in the business, like all of these things. You
Mhm.
can also allocate it out to a holding company. So it's a way of continually purifying a company that has excess cash.
Mhm.
But trusts have downsides too,
Mhm.
especially in the last number of years. So you're talking an extra tax filing, extra disclosure, potentially an extra bank account, depending on how things go, right? All of those things have costs. In addition, trusts have a tax consequence. So if money is left in the trust, it's going to be taxed at the highest marginal rate, right? Every 21 years, trusts have a tax birthday, which means any capital asset that the trust owns, yard sale, it happens, right? Trusts don't die. So we create a birthday for trusts. So those shares that the trust owns in your company, guess what? We have a birthday. They're going to be deemed to be sold and reacquired, and there's a tax bill.
Right.
So sometimes people bring the family trust in too early because
Mhm.
the ultimate goal is you kind of want to be at the place where by the time you get close to the 21st birthday, mom and dad are actually thinking of transitioning anyway. They're thinking of selling this to a third party or they're thinking of transitioning to the next generation. And so then this allows them to do some planning in advance of the 21 year to be able to take the stuff that's in the trust and give it out to capital beneficiaries. And you
Mhm.
can do that on a tax deferred basis. If you do it too early, though, like let's say mom and dad are like 25, you put the trust in
Mhm.
place, mom and dad are 46, now we're at 21 years. Well, mom and dad probably don't want to give up the business at this point. So then you're just going to give the shares back to them and we're right back where we started, at the
Yeah,
beginning.
that's good.
So that's why I find sometimes people do the planning too early or they don't necessarily understand the consequences of the planning or what its intentions are. So when you're bringing in a trust, common structure, but let's figure out if it's the right time and let's talk about what we're going to use it for so we don't pay a bunch of
Mhm.
fees for nothing.
Mm. Oh, that's fascinating. Just to confirm what you just mentioned is add the 21-year rule. Basically, what you would do is you would disperse what is held from the family trust to the kids. So now they would be owning the common shares, right?
It's typically
Instead,
used as succession planning, right?
yeah, okay. Are there any other strategies that could be used to avoid having to distribute what the family like essentially are there these strategies where you wouldn't have to dissolve the trust because that's what you're doing essentially at the 20
Right.
year you would dissolve the trust, dispersed out you called it the capital, like the capital assets or what the trust is holding. So is there other ways that you could do it without having to disperse the holdings to the beneficiaries?
Well, I mean, you got a couple options, right? No, there used to be more options. I mean, tax lawyers are very crafty. You got to give us that. So
I'm sure.
people have come up with all kinds of ideas. They're like, we'll create a new trust. We'll move it to the new trust. Nope, see, already shut that down. I mean, there's lots of fancy stuff, right? But you have to think about, okay, who are the beneficiaries of that trust? So the beneficiaries, there could be a large group. As long as they are a capital beneficiary and as long as they're Canadian, there's somebody that could receive the capital assets, right? And those people are entitled to a tax deferred rollover under the act. So they receive the asset at cost. They don't receive it at fair market value. So you're kind of, again, you're like pushing the tax problem down the road, right? Because if that person or entity goes and sells the shares the next day, well, they've got a tax burden, but we've moved it out of the trust. So when you're getting to the 21 years, you either do nothing. And if you do nothing and there's capital stuff in the trust is going to pay the tax. The problem is the trust doesn't often have the cash to pay the tax, right? Because you haven't actually sold anything. It's a deemed disposition. So you have to make sure you have some planning in place to figure out how you're going to pay it. But we have a lot of people that just say, I am not ready to pass this on to anybody. So let's just pay the tax and call it a day, right? So that's one way. Another way, if you're not ready, is mom and dad can take it back, right? Then we start all over again, create a new trust, do the whole thing again. You can also pass it on to other beneficiaries, right? So there's different ways you can approach it, but it really depends on what's happening at the time and who your beneficiary list is. And we have a lot of people now whose kids are like living somewhere else or have, taken up residence in the States or somewhere else. Well, some of these options are no longer available if you don't have a Canadian residence. So the plan you might have had 21 years ago is not the plan you have now because your kids are everywhere. So that's a difference.
Moral of the story is this stuff's complicated. You need help, right? Like
it is.
At the end of the day, like what I'm hearing, especially as I'm hearing you go through that sequence of events that needs to happen and how everything gets structured, is that it does get quite complicated, and yet the outcome is preferred, right? And so if in most cases, right, if you do planning well, and so I think at the end of the day, there's a lot of people who might resist paying for value or like seeing the value in what, a good tax lawyer can provide for them, a good accountant can provide for them, or even financial planners. But there is a lot of complexity built into this stuff. Our tax system is not an easy one to understand. So I think that there is a lot of value, like a ton of value. And sometimes, like you mentioned the passive asset test a while back, there's up to millions of dollars in potential value by making sure you're structured right, getting the right advice. And there's so many people that either just don't pursue it, don't have access to it, or just don't know what they don't know. Right. So it's really valuable.
Exactly.
Like the podcast that you're doing, even just like explaining it in this format, I'm sure probably some of that went over our listeners' head. But that's okay because you don't need to be an expert in that space. You just need to understand why you're doing something, who to contact, and how to get it set up.
I agree.
Yeah. I really love how you explain about the freezer and you take out the freezer. Can you talk about like how has your approach evolved to talk about these like complex strategies to people who have like little to no knowledge about that? I feel like they're experts in their own sector and industries, but like when you come to like financial affairs and tax and law, like usually they have little comprehension. So can you talk about like how your approach has like evolved over time and just how you've changed and how you explain these concepts?
Well, I mean, my background is not business and tax, right? Like I
Yeah.
come into this with a psych undergrad. And so I think sometimes I
Right.
explain things the way I've learned them. And so I don't work with numbers. That does not help me. Like if you start throwing a bunch of numbers at me and my eyes glaze over and I'm like, oh, I want to do lawyer math. That's what I call it. You know, we use rounded numbers. We make it easy. We don't make math the focus. Can I do math? Yes. Do I have spreadsheets? Yes. Like I can do it. I'm very good at it. But is that
Yeah.
how I'm going to communicate with my clients? No. People want visuals. They want pictures. They want to touch things. So sometimes when we're working on estate planning, I'll bring in like actual buckets for the beach, like sand buckets, and we'll talk about what's in each bucket. And maybe there'll be one bucket per kid. And we'll take pieces of paper and we'll start throwing them in the
Hmm.
buckets. We'll be like, what are we putting in the buckets? People need tangible
Yeah.
things. They need to feel it and they need to see it. And so my focus has always been, how can I learn this to then explain it? And a lot of it comes from how I was brought up. My dad was a university professor of anatomy for many years. He was a fairly famous neuroscientist. And so I grew up with my dad having this love of learning and this love of teaching. I was always in his lectures. I was sitting there listening to him. At home, he was constantly finding an excuse to lecture. We had brain models all over the house. I'd bring friends over and someone would say something. He'd be like, just a minute. And he'd go run into the dining room and grab his brain model and be like, did you know this part of the brain? And he was very tactile, right? And then I taught at the university for about 8 years. I taught wills and estates. And so I learned how to interact with law students and sort of how they like to learn. And that just kind of carried over into the way I talk to my clients. And so I have many clients who come to me now because they've heard that I explain things and they come in and go, listen, like, we don't know what's going on and we're really nervous about this. Can you just dumb it down for me? And I'm like, it's not dumbing it down. Like, let me explain it to you in language you understand. Like, let me use the language of your business. Because if I was to go to one of my farming families and say, you know, how do you prepare for combining? Well, they'd have to dumb it down for me because I don't know, right? Like everybody has their own specialty and it's something to be embarrassed about. Let's be curious about it. And that's the approach that I've tried to take.
Mm. What are some? I know we talked about this in in our previous conversations, but I want to hear more about how do you account, or what are the non-financial
Mm.
considerations that you usually tend to face, that we often tend to forget when when we're talking about estate planning, business succession, and implementing those complex strategies.
hmm Well, I think the number one is flexibility. So, frankly, I don't
Yeah.
think there's a circumstance where you can save the most tax and have the most
Mhm.
flexibility. Like if there's a
That's a
line
good
there at
question.
either end, right? And you can get in the middle, but you're giving up something on both. And I feel like oftentimes clients come to me and they want flexibility, but they also want to pay tax. And I'm like, well, I can't give you both. We need to give up a little bit on each side of things. And so often what I will do is I'll start with asking clients, what is it that you want? Like if you could look into the future, what do you want it to look like? And then from that, I start to identify, their goals are, I don't want to give up power. I think that's a common one. I want flexibility to change my mind. I want full access to cash, all of these things, but I don't want to pay any tax. Okay, well, you're going to pay some tax. But if I let you pay some tax, I can get you all these other things. And so we actually start listing them out. So I will often do like diagrams for my clients. I put in the corner like a big letter A, and then the next one I'll have a big letter B, and I hand them to them. I'm like, here's your options. Let's go through them. So with letter A, and I put at the bottom, here's your goals, here's what you get, here's what you don't get. And here's what the cost is. For letter B, here's what you get, what you don't get, here's the cost. What do you want to do? And then we talk through what's most important, because I think the flexibility issue is huge, because sometimes clients don't realize that things will change in 5 years. And what they have vehemently said to me will never happen. Then they phone me up. They're like, so it happened. And I'm like, well, we made a decision 5 years ago and now we can't do that. Do you remember us having that conversation? Right. Like, I think there's always different doors. And the sooner you seek advice, the more doors are open. As you start reorganizing and as you start making decisions, you start closing doors. And sometimes we can't open those doors again. And it's really important for clients to know if there's a door we can't open before they
Yeah.
do it. We can never open this door again. And sometimes that happens, right? We'll have clients that give stuff away and then they're like, well, I want it back. Like, well, you can't. Like, you gave it. It's not
Mhm.
yours anymore. And there's that sort of like, whoa, like this is really undoable. Yeah, it's undoable. Like a gift is a gift. It's been accepted, like it's done. And I think when you're dealing with succession planning and you have this complexity between parents and kids,
Mhm.
and you never have all the kids in the business, right? Like never.
Yeah.
You guys see this all the time.
Yeah.
You've got a family, there's 3 kids, one's in the business, the other 2 aren't, and then we get this, well, how can we treat the other 2 equally? Fair doesn't mean equal. We all say that as advisors, right? But everyone gets real concerned. Well, what about the non-business kids? They're going to be upset. Yeah, they probably are. Let's start having a conversation. Like, how are we going to deal with this? Because we can bring them into the business, but that creates a whole host of other problems.
Mhm.
Or we can start building something for them outside of the business, right? Or you can look at it that the business is kind of handing someone a liability. And if they don't run the business properly, they're not going to have anything. And so this lump sum of cash that maybe is a third of the value of the business that you're handing over to this kid that they can take and invest and go build themselves is actually just as valuable as the business that you're handing. So getting people's heads around that concept, it can be a lot sometimes. Like it takes time. People need time to process it, to think about it, to go away. You don't make these decisions in one
Amanda,
meeting.
you're like giving me
Mhm.
flashbacks to living in Saskatchewan and having that exact conversation with every single farming client that I've ever
Yeah.
had. And the one kid who isn't a farmer and is going off to do
Yes.
something on their own. And it's like, well, I
Yes.
mean, my other 2 kids, they're gonna run the farm, and that's a lot of work. And so maybe they do get a
Mhm.
little bit more in terms of total dollar value of the estate, right? And like exactly like you
Mhm.
said, the lump sum of cash comes with no headaches, right? And
Exactly.
having those conversations though is so crucial to a successful estate plan. We had an an estate, I kind of will call them estate expert. They basically counsel families
Sure.
through the estate planning process in a lot of the
Mhm.
non-financial considerations. So how do you have conversations with kids, and how do you make
Mhm.
sure their wishes are known, and those types of things?
Mhm.
And how do you actually do a will that gets executed properly? Right. So that there isn't conflict,
Yes.
there isn't lawsuits, there isn't strife between families and those types of things. And, um, you know, conversations and continually being open about your intentions have to be at the forefront. And before
Mhm.
you administer it or something happens, addressing the potential conflicts is so important to
Mhm.
maintaining unity within a family. Because I think, for most people, the last thing they want is for all the wealth they've created to cause strife in the family that they built it for.
Mhm. 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 No, absolutely. I can tell that you're probably getting some PTSD because it's
Yeah.
like that's what happens, right? We have these
Yeah.
conversations all the time. I feel like what's also starting to shift a bit is the conversation around
Mm,
insurance. So, I mean, I think
mhm.
insurance has a purpose. So I don't just think you willy-nilly get insurance, but insurance is actually kind of a cool way to create a pot of money this day and age, right? And so you raise insurance in the earlier years with clients, and you get this and like, I am not buying insurance. Okay, so I had done this with one particular business owner client for many years, and he phoned me up last week and he was like, so I'm thinking about this insurance thing. I'm like, well, now you're 75, you've had 3 heart attacks, so like we can think about it, but it's a different conversation than it was 15 years ago when I tried to. He's like, I know, but I wasn't ready then. I'm like, well, okay, but you just need to understand that there's now a consequence in terms of cash to you doing this now. You may not even be
Okay.
insurable. So it's a different conversation, but I think that having maybe this is the takeaway from this is like if you're a business owner and you're listening to this, don't wait until you're 60 and you're going to retire to
Yeah.
start thinking about this. Think about it in your 30s. If nothing else, to find out what your options could potentially be. So you can kind of start thinking about that because some of these things, if you start doing it earlier, it's actually way cheaper and it keeps a lot more doors open for you to then close later in life versus you wait until the end and then you go, okay, now I want to do this. And we're like, well, okay, here's your options. You now have 2 doors, not 6 doors. So I think earlier having the conversations is always better.
Mhm. Are there specific strategies that you've seen in your career kind of that usually tends to backfire, or people, is there certain
Yeah.
like that you could that are top of minds where people either end up canceling, abandoning, or just outright reversing that you're kind of like seeing like or you've seen like over and over again?
Yeah, there's a couple. I mean, I think the family trust example we gave earlier is one where people do it too early. They never use it. And then it hits its 21 years. And I found out after the 21 years, right? Like then they've gone and they wound it up. I find out later, I'm like, well, what did we do all this for? Like, what was the plan? I think that's one of them. The other one is the dealing with the non-farming kids and this idea that, well, I'll solve all the problems by just adding everyone onto the titles to the
Yeah.
farmland. That one I see a lot, right? So now you've got a bunch of people on title. Now you've got huge issues because dad wants to sell. One kid that's on title goes, "We're not selling this, not for that price." And dad's like, "Well, I own this property." No, you don't. You all own it now because there was no legal agreement at the time. So I see that a lot. You see that a lot with cabin properties too, where you get parents that try to twist themselves into a pretzel to figure out how to pass the cabin property on to the next generation. And I mean, yeah, you can do co-ownership agreements, you can create trust, but like all of this is complicated. And the more people you have that own something, the worse it kind of gets. So sometimes it's the giving stuff away, but thinking you haven't given it away. That's the next thing I see people do a lot. And then they realize the consequences when they think they still have control, but they don't.
I want to shift gears just as we're kind of coming to a close of this podcast, if that's okay. You mentioned early on that you thought you were going to spend a lot of time in your career on advocacy. And I
Mhm.
imagine that desire didn't go away. So I'm curious to know how you've like actually implemented that in the tax side, like what measures you've taken, but also like, are you working with organizations? Are you speaking to government officials? What kind of tax advocacy or just general advocacy are you involved in now?
Oh, that's a great question. I don't ever get asked that. That's an interesting question. I've always been a bit of a rabble rouser. And so a lot of people don't know that when I was in my late teens, many moons ago, I worked for the provincial government. I was working for the Children's Advocate Office in Saskatoon, and this was during the time when we had an NDP government. There was a lot of funding to young people, and they had provided funding to create something called the Provincial Youth Delegation. If any of my fellow delegates are listening to this, I haven't talked to them in a long time, but it was great. It was a great time. And so I was the leader of this group. And as part of this, what I had to do was we would storm the legislature and we had press conferences and all of these things to try to promote certain things for young people in the province. And the delegation was made up of kids in care, kids in custody, and then just kids like me that grew up in middle class homes that were trying to help and support and learn. And I traveled the whole province. I spoke across Canada as like an
Wow.
18-year-old, right? Talking about community advocacy. And I spent a lot of time, talking to the local government officials about what needed to happen. And I developed a curriculum piece at the time that was used in our school systems for quite some time later called the RAP Project, the Rights and Advocacy Project. And so we talked about people's responsibilities as well as people's rights and tried to instill in kids that there was a balance between those things. So that was kind of where I came from, which is why advocacy was important to me and that I believe in empowerment. I think empowerment is a form of advocacy. And so when I got into tax law, because I thought I could only do that as a civil litigator, right? I'm like, I'm going to be a litigator because that's what's going to work. So I think tax litigation is a form of advocacy because the client is up against the big man, right? They're up against the government. And so there's a bit of a Goliath sort of idea where it's like, oh, I'm up against this big thing. And so part of where I think I get my advocacy out is that I allow the client to feel empowered in that situation that, you know what, we can do it. Together, we can do it. We're going to walk together and I'm going to support you and I got your back. That kind of idea. So there's a lot of advocacy there. With my estate planning clients and my business clients, there's advocacy in a bit of a different way because I'm trying to get them what they want. So when they tell me what their goals are, I'm like, you tell me, I will do what I can to get that for you. And I think that's an important piece that we don't talk about. But I think then from the sort of outside the billable work context, I am deeply involved in the Society of Trust and Estate Practitioners. And so I know we've talked about that. I really want you to get your TEP. I thought I convinced you. It's a great organization. And I'm currently the chair of their public policy committee, which is really where my heart is, right? And so we are lobbying 24/7, right? I mean, it's we have all kinds of exciting projects on the go right now. And our goals are to, help fix some of the legislative problems across the country. So working with governments to educate the governments on where the practical problems are coming, working with financial institutions and some of the larger institutions to kind of fix some of those issues, and then educating the public and educating our members. to get people to a better place. So as part of that, I get to be part of the STEP Global Public Policy Committee, which is really exciting because they're working on a big project right now where they're trying to get reciprocity for the use of powers of attorney across the globe. So right now, if you have a power of attorney in Saskatchewan, for the most part, it's usable in the country. With exceptions, Quebec, some Ontario rules are a little bit different. In the Northwest Territories is a bit different, but it doesn't work in the States, right? It doesn't work in Singapore. It doesn't work elsewhere. And so our clients that are global are having to get powers of attorney everywhere around the world, and it's super annoying. So is there any way we can get people together to agree that, well, at least there's this base set of clauses that can work? Can we get governments to agree? And so this committee is making huge grounds in convincing governments to do this. This is the type of work that lights me up, that gets me excited. I think as advisors, we have a goal to give back to the community. I think that's part of our job. We've been put in a position where we can advocate, so why not use it? And this has been a really fun platform to actually get things done, which is really exciting.
Amazing. I love that you said empowerment is one of the keys here, because for the longest time I had in my head that, financial literacy is what will elevate, the rising tide that will elevate everyone. But in reality, you can have all the information and still make wrong decisions, because we're not just information beings. We're also emotional. But like resources provide empowerment, right? And tools provide empowerment. And so it's more than just literacy. And being able to advocate on behalf of clients, or even just in the tax scene in general, is really cool. I have one more question for you. If you could change one tax law, just one, in Canada, what would you change and why?
That's a nasty question. There's been so much bad stuff. Okay, I think there's two things. Can I say two? I think one, I would get rid of the entire TOSI regime. Like, just go back to the way it was before. It was great. Just take it all out. No more tax on split income. That would be number one, because all of my letters to the government went unanswered when that happened. And then I think number two would be changing the regime for taxation on death in terms of the long-term testamentary trust rules. So changing it back. So, I mean, in 2016, 2017, these changes were implemented where now if you have a testamentary trust that comes in your will or created after death, it's taxed at the highest marginal tax rate unless it falls into a qualified disability trust, which is a very narrow scope, right? So I think going back to this idea of allowing people to structure their affairs, maybe putting some limits on it, but that was a really nasty regime that they put in. So those are the two I think I'd try to switch.
That was a fascinating conversation. I know we're up to the hour here. Amanda, I'm going to put in the show notes your website, of course, your LinkedIn, your Instagram, which I saw you're pretty active, and then also the links to the Tax Chick podcast that the listeners can tune in if they haven't heard it already. But yeah, just wanted to end. Of course, the listeners, you can always find us at mwadvisors.ca. If you want to, book a meeting, subscribe to our newsletter and get in touch. And then we'll put all the links to our social media as well. But Amanda, thank you so much for coming on the podcast. It was really insightful and fun conversation.
Well, thanks for having me. It's always fun to meet fellow podcasters too in this space.
All right. Thank you so much and have a good day.